Indian equity markets are trading at an all-time high. Since the market turned around in May this year, 49,158 crore rupees have been pumped into our stock market. 20,717 crores of this came in from FIIs and 28,440 crores from DIIs, which leaves a negligible slice of the pie to retail investors. The new government is focusing on rebooting our infrastructure sector, and channeling retail savings into long-term projects is top of mind.
There is certainly a need to direct savings into financial instruments, and really the savings rate in financial instruments has dropped significantly over the last few years. Tax ops is for investments in infrastructure, maybe in the form of infrastructure bonds and savings of the type and tax savings of the type we had under Section 80 CCF. What we could also expect probably is some amount of increase in the interest allowable on housing loans.
Repeated attempts by the UPA government to draw retail investors to equity have failed. Even the much talked about Rajiv Gandhi equity savings scheme for first-time retail investors saw no success for more than one reason. The product design was far too complicated and the tax incentive was too small. The new pension system or NPS has been open to the general public for 5 years, but poor service standards and the lack of customer education has meant the product has had no takers. Analysts hope the government will now turn its focus to pension reforms.
It will be a validation of all the things that were stated. And I'm not expecting any magic, but mechanism to channelize long-term savings and simplifying things the way we interact with the government, these are only two things which I'll be looking at.
Simple products, attractive taxation regime and of course investor education are the only ways to ensure that retail investors once again look at equity investments as a preferred saving option. A task though not easy to achieve for the policy makers and regulators. With Vijay Ganeshan Iyer, Venkatesh Rao, ET Now, Mumbai.